The corporate spread, also known as the credit spread, represents the additional yield or interest rate that investors require to hold corporate bonds over government bonds with similar maturities. Here are the key factors that drive corporate spreads. Credit risk. The primary driver of corporate spreads is credit risk. Investors demand compensation for the risk of default associated with corporate bonds. Factors that affect credit risk include the issuer's financial health, credit rating, and the overall quality of its assets and cash flow. Credit rating. The credit rating assigned to a corporate bond by rating agencies, such as Moody's, S&P, and Fitch, plays a significant role in determining spreads. Lower-rated bonds, often referred to as junk bonds or high-yield bonds, typically have wider spreads than higher-rated investment-grade bonds. Market sentiment. Investor sentiment and risk appetite can influence spreads. Positive sentiment can narrow spreads, while negative sentiment can widen them. Events like financial crises or geopolitical instability can lead to changes in investor sentiment. Industry-specific factors. The industry to which a corporation belongs can affect spreads. Industries with higher perceived risk, such as technology or energy, may have wider spreads compared to more stable sectors like utilities or healthcare. Company-specific factors. Individual company factors, such as financial performance, debt levels, management quality, and litigation risk, can impact spreads. Companies with strong financials and low debt are typically associated with narrower spreads. Liquidity. Liquidity conditions in the corporate bond market can influence spreads. Less liquid bonds may have wider spreads because investors demand higher yields to compensate for the difficulty of buying or selling these bonds. Supply and demand. The supply and demand dynamics in the corporate bond market can affect spreads. An increase in demand for corporate bonds relative to their supply can narrow spreads, while oversupply can widen them. It's important to note that these factors are interconnected and can have varying degrees of influence on corporate spreads at different times. Investors, credit analysts, and portfolio managers assess these factors when evaluating the credit risk and potential returns associated with corporate bonds.